too good to be true. I'm pretty interested.
Yeah, and so for those who couldn't hear that or just repeat it, curiosity is how do you trade capital? How do you trade cryptocurrency in a capital gains tax deferral manner, which allows you to purchase real estate or other assets? And so the answer is it's called a deferred sales trust. And so the process is setting up an installment sale with a trust so that you don't have to receive the funds right away. And we'll give you an example. Let's just say Jim wanted to sell this amazing industrial art property here, and let's just say it's worth $20 million. And let's imagine he bought it 30 years ago for $1 million. He's fully depreciated to $0, and now he wants to sell it. He wants to do free and clear, so he has a zero basis and a $20 million gain. So first thing is defining the problem. In the state of California, state, federal, and Obamacare, it's about 40% is a good number of capital gains tax on the appreciation. So that would be $4 million and $4 million on each 10, so that's $8 million. So we always start there, make sure you define what is your actual liability, right? And so in this scenario, Jim would have to pay, $8 million if he were to sell, and so he has an option to do a 1031 exchange, but he can also do a seller carryback where, Piper might want to give a down payment for $5 million, and he can carry back $15 million, and he doesn't have to pay tax on what he hasn't received yet. It's known as IRC 453, which is an installment sale. And so it's a seller carryback. That's the foundation of what we do. Now, imagine Piper gave him a zero down payment. And, hypothetically, he could carry back all $20 million and defer all that tax. Well, that's exactly what we do with the Deferred Sales Trust with primary homes, businesses, real estate, crypto. And then we ask, let's imagine it's Jesse's cryptocurrency. It's worth $10 million. We say, hey, Jesse, would you carry back $10 million for this trust? This trust is going to pay you over time, and you'll slowly pay tax. So you could say yes. The ultimate buyer, though, is just the marketplace. And so we literally set up a trust as step one. Step two, we have Jesse sign a promissory note and assign her rights or her interest to this trust. Step three, we typically open up we use Kraken right now is the one we've done so far. We closed a $5 million deal for a client. She worked for Google. She bought it for about $50,000 and went to $50 million. And this is when Bitcoin hit $54,000 a coin. And so that was her exit price to exit 5. So we opened up an account in the name of this trust at Kraken, and she just transferred the Bitcoin. It's definitely simpler with coins that are on these major like Coinbase or Kraken. She transferred the Bitcoin to the trust. She didn't take any cash, right? But she received a promissory note for $5 million. So she's in a deferral state. Okay. Now the trust ends up selling it to the ultimate buyer, right, or the marketplace, and takes the cash. The cool part is because the trust got it for $5 million and sold it for $5 million, it has a zero gain. Okay. Likewise, if Jim sells it and takes no down payment at the beginning, he has a zero tax liability. He's in a deferral state. Now she'll pay tax as she receives payment, and so will Jim as he receives payments. So it's just an installment sale, seller carryback. But again, it works for primary homes, businesses, real estate. Now to connect the dots to how do you buy real estate with it, well, once it's in the trust can invest into whatever it really wants that you approve. It can be stocks, bonds, mutual funds, hard money lending. It can be a business. It can be investment real estate. Now, it can't be primary because the government doesn't give us any incentive. They don't allow us to put it into something that we're going to get primary use for. That's taxable. So part of our team, we guide you along that way. But it can be like commercial real estate property. We just did a deal for another client. He sold a $2.6 million business, deferred the tax. Now he's using the funds to build multifamily units, which is also a great way to help with the housing crisis, because the housing crisis is how do we get enough capital to afford to do to build these units. Stuff like opportunity zones are a great way to do that as well. But the Deferred Sales Trust is also great because it can do it through all asset types, and then you partner with the trust, and as long as you're using it for investment or business purpose, it remains in a tax deferral state. So I know that's a long answer, but you can go to capitalgainstaxsolutions.com. Yeah, sure. There you go. Come on.
Yeah. Also, it's a lot of information that he said. So how I found out about him was he has a class every Friday at 10 o'clock on Zoom. Thank you. Super. So it took me about 6 classes to finally kind of retain what he just said. So definitely check him out. You want to hear good, informative information, heavy stuff. You feel like you kind of know it all, and then you get in his class and you're just like, wow, I know nothing. So yeah, definitely check it out. 10 o'clock Fridays.
10 o'clock Fridays, you go to capitalgainstaxsolutions.com. You can check out my YouTube channel. Do we have another question for anybody else? Walk back again. Hold on 1 second.
How long is your hold period for these funds?
So with the deferred sales trust, by the way, not to be confused with the Delaware statutory trust, that there is no timing restriction. So there's no 45-day, 180, shotgun wedding with a 1031 exchange. The funds can be set in the trust typically for 10-year periods of time, and every 10 years you can renew for 10 years. Think of it like a mortgage, right? You're becoming the lender. You can refinance every 10 years. We typically structure with an 8% interest compounding rate of return over that period of time. You can take interest-only payments or partial interest, but every 10 years you can renew, and you can pass it to kids, and that's the whole idea. You can use the time value of money, right, to earn interest on what you would have paid to the government to build wealth. And the rule of 72 kicks in. If we can earn 7% compounding over 10 years, we can double that amount. And so, in fact, Susan right there with Overscore's title, she is my go-to strategic alliance for all things escrow for these deferred sales trusts. She's amazing, and we work together to close these, and we've closed a number of them. And I'm trying to think of one that was recent. In fact, we just closed one in Placerville, $2.5 million property just a couple days ago. And for them, their biggest thing was they're moving from phase 1 to phase 2 of their life, and they do not want to trade 15 problems for 30 problems. They have 15 tenants. They got 15 problems. They don't need 30 problems. They need to be able to retire, and so they're going completely passive, and they're going to live off the interest of this $2.5 million over time. They're deferring about $1 million in tax, and then they'll invest it whenever they want to along the period of time. Now, we love commercial real estate, passive multifamily deals. We love some crypto. We love conservative S&P 500 stuff. But it's really what the client wants. But at any point they can get out and just pay their tax. The question is, what's their time horizon? What's their risk tolerance? A number of things that come into that. So thank you for the question. Anybody else? For any of us up here too, it could be about mortgage, it could be about insurance, it could be about commercial real estate, it could be about anything. Any questions from any of the audience members out there? Raise your hand. Oh yes, we have another one. There we go.
This one is for Jim. What would you say to people who are just hyper-focused on getting the lowest rate they can find online for a mortgage or getting the rate that their neighbor or their family member got a year ago?
Excuse me. So starting with rate is the wrong way to buy a mortgage. And I think what's important is that you can go online right now and you can do a search on the internet for mortgages, and you'll get thousands of results for an automated mortgage, and hopefully you get what you want. The problem is those robots that are preparing that mortgage for you, they don't take the time to understand what your situation is. They don't understand the overall financial goals that you've got. So I think it's really important to work with a mortgage strategist, a human being. Realistically, the plan should be much more robust and include a whole network, a team of professionals who help you get to where you're going. And what happens is it's not just a binary one-time event. As you're accumulating wealth, things are changing. You're gonna need bread in your life as you have these highly appreciated assets, right? To control taxes and have a thoughtful tax mitigation strategy in place. At least tax deferral. I guess it's not mitigating, but it's deferral. And so, but at all of that, good CPAs, good trust and estate attorneys, and a good strategist. And then once you've got all that advice and you still want to go shop the internet and do it on your own, then buyer beware. But it costs nothing to talk to a good mortgage strategist and make sure all those pieces are in place.
Anybody can answer. It wasn't me, but let's say I won the Mega Millions lottery. The guy believes it. What's the best state to move out of California to obtain the majority of it?
I'm not taking it. First of all, can I defer capital gains tax on lottery winnings? The answer is yes. Okay, so this is actually we were working on a deal like 3 months ago. We haven't closed the lottery deal, and then ended up not closing it. But I didn't even know it. But it can, and so that would be the first thing. So if you were a mega millionaire or someone you know is, then you should talk with us before you take constructive receipt. Okay, before you receive those funds in your personal account, we can set up a trust prior to it. But let's imagine you want to pay the tax and you're happy about that. which is fine. Then what states are really favorable? Well, there's places like Nevada, Texas, Florida, Puerto Rico is the best, right? There's places like Tennessee, the Carolinas are pretty favorable, called the Sun-West Belt states. However, realize that the state in which you reside, my understanding is if you've won it, you can't just, hey, I'm gonna move to Puerto Rico and then take it, right? So it's not that. That's where we come in. We like to say we're like the crypto billionaire or millionaire, exit plan or real estate, whoever it is, without having to move to Puerto Rico. So, and then to answer your question, Jim, we do have something called the Deferred Sales Trust Plus, what actually eliminates the estate tax, which is something we didn't touch on, or we, at least in today's discussion, where we can eliminate that for net worths above 22 million married, 12 million single, set to cut in half in 2025. So there's always changing laws and changing, things. And I like to really give the analogy of a Rubik's Cube. And each of us have a Rubik's Cube with different colors on every side of it. And each cube represents a part of our net worth, a part of our financial plan, a part of our cash flow, our tax flow, our mortgage strategist, our cryptocurrency strategist, our insurance. And each of these cubes are a little bit different. And the key is to bring your cube to one of the experts or experts that you know to help you make that cube congruent with all the colors on all the sides. Has anyone seen those amazing people in 6 seconds they can put it back? I don't know if anyone, I got sucked into one of the documentaries on Netflix and I was just like, wow. In 6 seconds they can take it and make all the colors the same. And so that is part of our goal, is to figure out what is your challenge with lottery winnings, where can you live, where can you establish residency, and so that your cube, cash flow, tax flow, personal things, charitable giving, all of these things take a team that are experts in their niche. It's not just one person. And the other analogy I like to use is the Roman legions. You guys see those movies, right? Like 300, where they all have their shields and little spears, right? So each of us has our shield and our spear, but if we can all line up together around either yourself or clients, and now we become a force, right? We can each fend off. One of us can't really do it, but all of us together, we can really make a huge difference. So that's the key. Hopefully that answers the question, sir.
I like that.
All right. Who else has a question? Yes, sir.
I have a multifaceted question, and I apologize ahead of time. One for Piper is, do you have a marketplace that typically your crypto investors would look for real estate because there are like-minded people on either side of the equation?
I can't, I've been slowly building one myself. It's been very slow because of the way the market is right now. I don't want to sound like a jerk, but I'm one of the only ones who actually knows how to do these deals, and I have the people in place to do them. If you go and just Google something like that, like a marketplace, there are a lot of platforms that say that they can do it. A lot of them, most of them, I don't know how. A lot of them are fake. First of all, I don't even know where they get this, and they're aggregators and whatever. And there's one particular person who was a reality personality that actually started one this year, and I don't think that there's any merit to that either. I know for a fact that they don't know how to do these things. So, there's, like I said, there's a lot of platforms out there that say, but I don't know how above board they are in doing them. And I certainly wouldn't, log on to one and give someone my Bitcoin for some house in Italy that may or may not exist, So I, get me or someone who, like an actual real estate professional, wherever you're looking, and then, kind of work backwards from there. Really, there's not a lot.
Thank you. And then the second half of the question
Sure.
was, have you combined and it sounds like you alluded to, you probably have combining idiots with your installment sale program. Is that something that you have done intentionally, defective guarantor trusts, et cetera, to separate out the gains, et cetera? Have you worked in combining that with your installment sales? And then the last part of the question would be, Jim, how would you underwrite a trust buying with a property of this type?
So I'll try to answer your question, but I'm not quite sure I understand. Can you restate the question maybe again to see if I understand what you're saying?
So you're creating the installment sale trust, basically, and have you combined that with an intentionally defective guarantor trust vehicle
Okay.
to also pay the taxes of the trust gains that are within the trust?
So I have not, and we specialize like a laser on the deferred sales trust. We do get approached with these other types of trusts because there's thousands of different trusts. What we found, generally speaking, is you want to make sure that whatever trust that you're going to look to do, that they've been tested, number one, by the IRS, okay? So the Deferred Sales Trust is thousands of closes, billions under management, over a dozen no-change IRS audits. It's been through the fire. And not that that way might be working, it might even be better, but the question I always have for whatever that is, and maybe it could be awesome, is how many of those has that attorney done? And I'm not the attorney, by the way. I call my business partner, I call him the Elon Musk of tax, and he's brilliant, CPA tax attorney. He's the one who created it 26 years ago and taught me basically everything I know. But the question is, A, what are you trying to accomplish? B, has that person done those before? C, how many of those that he's done has it been tested or audited by the IRS? And then D, are they providing lifetime audit defense? And so there have been copycats and those that have popped up and now have on the Dirty Dozen IRS list. And I'm not saying that one is. It could be an amazing one. We don't really dabble in anything else besides just our niche focus that it's been proven 100%, working every single time. Biggest deal was in San Diego, $125 million. So I don't know. But I'll pass this to Jim. Jim, if we have a deferred sales trust, what are some questions that you might ask to make sure that someone might be qualifying? Maybe you have to ask me a question on that too.
Yeah, I might have to. So if first off, the DST is not financing anything, right? So we're not going to create financing for the trust. The trust is a pass-through, basically, where it's really the ultimate buyer. So if you're selling your house that's appreciated and you want to put it through the DST process here, it's whoever the buyer is, that's my customer, that's my client. That's how I'm going to finance, not the trust.
If I was within the DST, I can buy all sorts of assets.
So.
If I wanted to additionally leverage that and to use the DST as the structure by which to buy other properties, it would seem to me that the DST is probably not a see-through or pass-through, or is it?
So.
So
my understanding, Brett, is that the DST would create an LLC to buy property. Is that right?
Yeah, this is the most important part of this, and this is the reason I started the company, was for what I'm about to say. And if it wasn't for this, I wouldn't even be on here with Capital Gains Tax Solutions. So the ability to partner with the trust, this is very important. Joint venture partner by, let's say it is Piper's Deferred Sales Trust. In fact, also remember that she doesn't own the Deferred Sales Trust. The trust owes her the money, okay? And so she's lent the money to the trust. However, she can form a brand new LLC the next day after the trust is formed and the funds go there. And the trust can be a joint venture partner with Piper. Okay, so she's 100% owner of an LLC, but then after that, the next day we amend the operating agreement. The trust puts up all of the funds typically and asks for 20% ownership. Okay, and sometimes we might do 19% ownership, right, for certain mortgages that are going to be, applied for, and Piper's going to use her credit and her experience, and she's going to be the, her track record, and the bank's going to underwrite her and the property, and it's going to look where the source of funds are going as well. And so banks are different, and there are different requirements for who might approve, who might disapprove, who it's a little bit outside of the box. But for the ones that we have closed, that's the way they have underwrote it. They look at it as a silent joint venture partner, and that's number one. And then what the actual cash flow of the property is doing, number two. And then overall, they're going to finance Piper and the LLC as a whole because she's the active general partner running that deal. Now, we did another deal for a primary homeowner, and one of my clients out of Walnut Creek, they sold a $1.4 million commercial property, deferred all the tax, and they wanted to buy a condo, 1.2 million or so in San Luis Obispo. And they called me up like, hey, Brett, we want to put into this. I go, was it going to be your primary? And they said, yeah, well, that's not tax deferred. We can't do that. So I said, but how about this? How about we ratchet up the income? I go back to your mortgage specialist and find out what is it that your income needs to be in order to qualify for this loan. So they, oh, great. Called me the next day. They said it needs to be an extra $6,000. I said, great, let's turn on the trust. So they had it turned off before they turned it on, meaning we amended the promissory note. We started producing $6,000 a month, and we seasoned that for a couple months, and that allowed the mortgage professional to say, great, you qualify now, and they bought that primary home, not through the joint venture LLC, but because the trust is paying that income, and it's going to they're able to qualify qualified on that. So hopefully that answers the question, but I'm going to pass it back to you, Jim. What other questions do you have for me on that?
The only thing I was going to add is that we can also finance an investment property, 1 to 4 units residential, based on the rents received or appraised rents of that subject property. So, which eliminates, we still have an individual borrower, Piper in this case, whose credit worthiness is on the line, but we're not going to worry about what the tax returns show. We're going to worry about what is the proper, do the rents on the subject property cover the total housing expense, what we call PITI, and if so, then we can make the mortgage. So, does that
answer the question? How does that sound? Pretty good? Okay. We have another question there? You want to, hold on one second, let me bring the.
Who manages the trust?
Yeah, so in the deferred sale. Yeah, so in the Deferred Sales Trust, there's a couple different parties. There's the DST tax attorney who does the legal work and brings that to like kind of like the transaction part of it. Then there's the trustee, that's our role at Capital Gains Tax Solutions. We're sort of like the offensive coordinator. We are the third-party trustee, and so we are managing the trust. But we also use third-party financial advisors. So we keep transparency and accountability by having these three separate entities that are all working as a team to execute on the trust, okay? And so we also work with qualified, amazing real estate developers who are, you can go into passive or active real estate deals with the trust. And so the key is diversification. We work with a group like Dan's group, right? And Castle Funds to invest passively into a fund like that. But you could also form an LLC yourself, and this is my favorite part for the entrepreneurial real estate person or even cryptocurrency person that wants to actively manage some of those investments. They can. We do that through the joint venture LLC. Now we got to follow some guidelines, and we got to make sure that it's all business purpose and investment purpose, right? And then we have a third party group actually we use out of Morgan Hill, San Jose, who does the tax return for the trust. So it's literally a whole team of people to make sure we're doing what we're doing. Hopefully that answers the question. So the day-to-day, like if Piper partners with the trust, she's running like she normally would. This is the beauty of it. Like let's say she did a $10 million sale on a property and she would have paid $4 million of tax, and she puts all $10 million into the trust, and then she partners with the trust to do $4 million to the LLC. She's literally running that LLC. She's opening up the bank account of the LLC. She's hiring the property management. She can pay herself a fair asset management fee. All of that's the same. The difference is she's going to have to pay back the trust, which owes her the money anyways, right? Because it's a silent joint venture partner. It's typically, structured at 8% pref and a 20% ownership, but they're a silent partner. So she's running everything herself if she wants to. Now, 8% pref means the first, 8% on the $4 million needs to be paid back, right? And then when they go to sell, it's an 80-20 split after that waterfall. There's also a way to carve out the upside if you want to get more upside, which is also a nice way to get more of the upside. So that's so the answer is that person if they want to, or if they want to retire, they can do that too, and we can help run it for them. Anyone else other questions? 8:15. We good. Brad, you got a question?
Yep.
Oh, no? No, he doesn't have a question. He's good. Hold on, we got one right here. We got a question right here.
And then Jesse, how does this all affect insurance, and if it's the trust owning it versus the LLC, does that create any complications?
So whenever we're insuring an asset, we always insure the asset as the asset is titled. So if the asset is titled in the LLC or in the joint venture, then we would insure, that would be the named insured. That is who gets paid in the claim. And if there's any lien or mortgage or additional interest, then that is added on as an additional interest to the insurance policy. So insurance agent to insurance agent, we would make sure that we have the proper named insured on the policy.
Good question. Anybody else? Anybody else? Great. Hey, I want to thank everyone for being here. This really is encouraging to have the numbers that we had. We weren't sure if we're going to have like 5 people or like 10, and to have everyone in here and participating and encouraging us has been amazing. I want to thank each of the panelists. You all were amazing. Thank you so much. Leah, where are we going? And
From the Bay, and there are reservations there. So please, we'd love to continue the questions, the conversation. You are who you hang out with, and, you obviously found a great presentation here, so thank you guys.
Thanks, everybody.
Thank you.